Good afternoon, everybody, and thank you for assisting to this webinar presented by SSQ Insurance. My name is Matthew Roy, Development Analyst here at SSQ. We are pleased to welcome today Johnny Quigley, Vice President, Institutional Investment Services at Hillsdale, here to talk to us about the Hillsdale U.S. equity strategy and the importance of not neglecting small cap stocks in a portfolio. Please note that if there is enough time at the end, it will be our pleasure to answer one or two questions that you can ask via the Q&A section of the WebEx interface. You can also communicate with your SSQ Insurance representative for all other questions. So without further ado, Johnny, the floor is yours.
Well, thank you very much, Matthew, for the introduction. Thank you, everybody, to be here during the lunch hour to listen to this seminar presentation on why you should consider adding some small cap to your portfolio. Matthew, if you could go over to the other page, slide 2, please. On slide 2, we have the table of contents. I mean, there's a lot of pages. Trust me, I will jump on many of those pages. And at the end, if, like Matthew mentioned, if you have questions, please feel free to ask them directly or at the same time with your representative at SSQ. If we could go to slide 3, Matthew, please. Slide 3 gives you an introduction who we are, Hillsdale. We're technically a little boutique on the investment side. We are in Toronto. We oversee roughly 2.3 billion assets under management. We oversee mostly only on equities. We do Canadian, U.S., and global equities. We're active. We're in business since 1996, so over 20-some years of active management on that part there. We have our own money in line with a lot of our clients, so we are able to acquire our own funds and at the same time some of our strategies. So trust us, we do have some money on the table like you guys. So when we invest with us, you know that we keep consideration on that part there. We are what we call fundamental quants. So yes, we think a lot of fundamental stuff, but we do it all by what we call on quantitative things. So we don't have a very big, large battery of analysts, but at the same time, we cover a lot of assets, roughly 40,000 companies on our data. We are in business with our friends at SSQ since 2012. And we are also, that's where we mentioned that our first introduction with those individuals. The fund that we'll be presenting to you has started on November 7, 2015. This is something that will be very interesting for you guys to look at and I think to promote to some of your clients. So if we could start off, we'll go to slide 3, please, slide 4. This is how I said we are partly a boutique. We're owned by our shareholders, and which is internally only, so we are partners. We have one private investor. Good news, financial firm. It's really a small firm that oversees us, and since those days there. We have roughly, if you go to slide 5, please, Matthew. We oversee, like I said, 2.3, and it's what's most important for us. We're not asset gatherers, we're asset managers. So yes, capacity is an important thing for us. So we want to be sure we always generate the alpha that we have promised to our clients and our individuals, and at the same time to avoid what's called the alpha decay, we be sure that all our strategies are well considered with the assets. So roughly, we have the return premium, the small caps bucket, and we have the all cap and the core buckets, which have roughly $540 million. So, and we also oversee what we call absolute return strategies. We have enhanced income strategies, Canadian long short, and global long short strategies. So yes, we have a bucket of all kinds of different things, and at the same time, it helps us to keep us on our edge, and at the same time, to find some opportunities for other strategies. If you could go to slide 6. Please, Matthew. Slide 6 gives you the view of all the strategies we have in place. And like we like to say things, the best part is to try to keep the highest quality to our investments. As I mentioned, we're trying to avoid what we call the alpha decay, very important for us. So to keep that part there, we have to focus, adjust, and I would say minorly move around some of our strategies. So over time, you could see that we maintain, since 1995-96, our strategies are in place, and the value add versus what we call the benchmark risk is pretty interesting. Plus, we are starting some new strategies because we're seeing more and more demand on some very specific things such as Canadian momentum or what we call the return premium strategies. These are the parts where we're seeing kind of an interest to really be very different from the benchmarks these days. So that's for us very, very exciting, and at the same time, I would say it compels us to bring out the best of our strategies. If you could go now to slide 7, Matthew, please. Now, the question is, why invest in U.S. small cap securities? And I think the part is every time an investor, Canadian investor, looks at the U.S., the first reflex is go to the S&P 500. Why? Well, I think the simple basic thing is we consider our Canadian market as small cap compared to the U.S. So why not try and diversify? Let's get some large cap. The problem behind that, it's not very compelling if you look on the alpha side. go to slide 8, please, Matthew. If you really think about that part there, the holy grail is really, in our space, is the value-added potential. And if you look at that part there at the holy grail, well, the potential value really comes from the small cap space. And it's very logical. It's the most inefficient market out there and the most opportunities market also. The strange part compared to the other asset classes, it's always the one that gets the less assets. It's between my experience since the last 25 years, between 5 to maybe 10% is really allocated to small cap. And if the strange part, you should put a bit more of that value behind that. So to be sure that things are in place, let's look at the real potential value add of an S&P large cap manager. Could we go to slide 9, please, Matthew? Over time, we're using here the investment universe. It's really neutral. It doesn't represent any kind of consultant part there, but it's really a data bank. And since the 1990s, you could see that the U.S. large cap manager, on average, adds roughly 100 basis points versus the S&P 500. Good news, bad news, it's not linear. You see over time some periods where the median manager underperforms, like the period from 97 to roughly 99, or the last period from 2014 to 2017. So there are some periods of time where it's not easy for those managers to add value because it's a very tough market, and there's a reason behind that. Well, we'll show you later. Now, if you could slide to slide 10, going to small cap, there's a potential there. You see over the thing, the median, and I'm talking here just the median small cap manager was able to add versus the S&P 500, not his benchmark, but the S&P 500, 350 basis points. So there is a premium to go into small cap. There is something there that you're able to add. And at the same time, if you're able to find the best manager out there, so you're really going for the first quarter, you're able to add roughly nearly another 600 basis points right there. So you're up to 998 basis points of value add over time on average. But there is periods, let's be honest, it's not, like I said, linear like the other guys, but there's some periods of time where you will underperform, and there is some periods of times where you will overperform. The question is, have you found the right manager? Could we go to slide 11, please, Matthew? That job there was given, I think, SSQ when they contacted us. Can we add value versus the S&P 500? This is our small cap strategy versus the S&P 500 on rolling periods of 12 months. And you see the green bars where that, like we say, we're green, where we have Hillsdale outbeating the benchmark is pretty efficient. Over the average, we have added roughly 810 basis points versus the benchmark, and our median returns around 610. So our skills are pretty good, and at the same time so good that we're able to add some value versus the S&P 500. It's not, like I mentioned, it's not always equal. There's some periods of time we will underperform, but they're not very, very long, and like I said, it's maybe an opportunity to put some more money at work when we're underperforming versus the S&P 500. Could we pass to slide 12 now, Matthew, please? The reason I said that's not an easy market to outsmart or to beat is because there's a bias. Let's be honest. Securities with $50 billion market cap and more are about nearly 69% of the benchmark. The sad part, it's only 114 holdings. You only have 114 securities that have that size. It's not a very big universe to pick the best names. It's a tough market to get that part there. The market where we always say the best value or the added value is really on the small side, which is roughly 5 billion and less. It's less than 10 basis points, and it's only 3 companies. So the potential value add over that part there it's not easy. And look at the market caps. I mean, the average weighted market cap is roughly 222 billion. The average market cap is around 49 billion, and the median. So that means you have as high as the number of securities over and under. It's about $21 billion. So there is a major bias, and that's all being dragged up by that 114 names out there, which is representing nearly 69% of the benchmark. On slide 13, you see roughly the top 20 names, and it's big. These guys are very, very big. They represent roughly 33% of the S&P 500, the top 20 names. And you knew the classic names, Apple, Amazon, Alphabet, Microsoft. There's roughly 5 companies there that have at least $500 billion of market cap. It's something very extreme. It's big. And then let's be honest, try and double that market cap. It's not easy. I mean, it's easier for a smaller cap name to $5 or $6 billion to double versus a 900 nearly $1 billion. $1 trillion. It's nearly a country in certain cases in some parts of the universe. So it's not easy. The names are very broad out, and you see a lot of information technology these days are showing up on that side there. So there is a kind of concentration also, a bit like the nifty 50s that we had in the 50s or at the end of the 90s. So you have to be concerned that these are factors, and when you're playing at that market cap size, you don't have that much breadth to be able to add value add. Could we go to slide 14 now, please, Matthew? Now, you see what I'm talking about, breadth. This is the reality. I mean, let's look at the benchmark. Large cap benchmark, the S&P 500 versus what we call the small cap benchmark, the Russell 2000. And yes, there's not 2,000 names because there were some bought out. M&A activity these days are pretty interesting and very competitive, so there's a lot of names being bought out. But still, we're getting closer to 2,000 names. You see that on the market cap side, there's one thing, but now on the holding side, when you're going into the small cap space, you have better breadth. You're able to add more names. At least you're not cornered in a situation like in telecoms where you only have 3 names to select from on the S&P 500 versus at least on the Russell, you have at least 18 names. So you're able to broaden out some names, and it helps you to at least select the best companies and not being stuck with a company by second decision, or you have no choice of taking that company into your portfolio just to control the risk. Could we go to slide 15 now, Matthew, please? On our side, when we look at the small cap space, we take all names that are not in the Russell 1000, which we consider as large cap, and right now, the total coverage of our universe in our data bank is roughly 2,541 names. So that's a lot of breadth. That's interesting for us. That gives a lot of opportunities to be able to invest, to add value. And on that side there, let's be honest, they're not all investables. I mean, there's some companies we consider you should not touch because, first of all, they're illiquid. Let's be honest, their financial sheets are very strange. In some cases, I would say maybe there's some missing data. So for us, on that universe, about 2,100 names that you're able to look into, to tap into, add value. And we call the small cap space, which is roughly $250 million plus. There's about 1,700 names that you need to go into. And on our side, we also look at the micro cap side because these are the next names that are going to be picking up themselves up into the small cap universe. And on that space there, we look at everything that has about roughly a $50 million market cap plus they're liquid and they're under 250 million. There's 434 names behind that. So you're able to find some very nice little opportunity sets. And these companies, let's be very honest, they're not very well followed by a lot of analysts. They have some very interesting backgrounds. They're in some very interesting sectors, and sometimes they're the ones that might be the next generation of the Googles, Amazons, and all that. At the same time, some of those companies also could be on the M&A activities, which means they might be taken out. So there is some potential to get a premium just to be in that space there, and to see them migrating from micro cap to small cap. Could we go down to slide 16, please? I mean, it gives you a view of how we look at those things. And the question is, once you add them into your portfolio, what's the impact of adding that to your U.S. portfolio? So let's go to slide 17, Matthew, please. You see, well, just here is technically it's our fund that we created for SSQ, and there's roughly 33% allocated to our U.S. small cap strategy. Just by doing that, you have a better, obviously, diversification on the sector side also, but on the capitalization side, look at it. At least you're not stuck with the classic mega cap names. You're at least 24% versus the 69%, so it's a much better diversification. Plus, you see that the money that's being tapped there has been put down more into the smaller cap names, which is roughly than $5 billion, and you have a better opportunity to add some value on the long run and be able to maintain that value added in a more efficient way, because more breadth gives you a better efficiency, and at the same time you're able to outsmart, I would say, the benchmark or the indexes more efficiently over time. The average market cap weight of our fund is roughly $42 billion versus the $22 billion of the S&P 500. But if you recall back, I mean, at least it's even there close to, I would say, the median funds, higher than the median fund. So you have a better view of technically this market cap portfolio is much more well diversified and has a better, I would say, focus on the right things to add value. Now if we go to slide 18, please, Matthew. You see the names are very different from what I showed you on the S&P 500. There will not be a name over about, I would say, have a market cap higher in that part there, but at the same time, the weights, it's a bit less. Just this one there is roughly 15%. The top 20 names represent 15% of the assets under management in that fund there. So you see that already there's something very interesting. There's not an overweight. Plus, on active share, that means are we very, very different from the benchmark? Well, yes, there's about maybe 17% that's similar to the benchmark. The rest, it's active. It's really very different. We're finding more better opportunity sets that are in the versus the benchmark, and we have to outsmart the benchmark at that part there. Could we go to slide 19 now, please, Matthew? Sector-wise, this is what we call our U.S. core strategy. This is the large cap portion of the SSQ account. And you see right there, we're finding some very interesting opportunities on information technology, healthcare, and materials. Well, the two first ones, it's pretty logic. With the trade wars that we're seeing actually that Mr. Trump has started, well, these are the only two sectors right now that are not very badly hit by that part there. So there's some very interesting opportunities, and the value behind that and the potential growth is there. So versus the benchmark, we're able to add more of those names in our portfolio versus the benchmark. Now, if you look at the other one, let's go to slide 20, which is the small cap strategy. It's a bit different. It's more domestic. It's more related to internal things. So you see industrials, financials, and healthcare. Well, industrials is more domestic. Financials, look, let's be honest, when you go down in the States, it's very different from Canada. It's all, I would say, open market. There's a lot of regional banks. You have a lot of, I would say, domestic banks that are very small. The market has about, I would say, 3,000 to maybe 4,000 banks out there. Some are interesting to look at, and some are maybe have to be neglected, but the potential is very interesting on that part there. And secondly, they are less influenced by, I would say, rates at a certain level, because depending on which region they are, they offer certain things that are very specific to them. The question is to avoid the meltdown that we had back in the 70s and 80s when all the oil patch or real estate more at the end of the 90s happened. So you have to be sure that technically you're well diversified, you're finding the right sectors in that part there to help those financials to be sure that they're not too badly influenced by interest rate moves or, I would say, cycle of markets that have really hurt very bad. Now, if you go to slide 21, you see when you look at the portfolio, we look at the attributes. We want to be sure that the attributes of this portfolio is very, very different from the index, because on the long run, you're adding in something that smaller cap, it has to make you very different, and you have to find what we call the growth part, so to be able to give you perspectives over time to be able to grow very interesting without being, I would say, overvalued or not being, I would say, to be sure that you're not paying an extreme price or valuation for those securities. So if you look at the portfolio as is, well, it is very attractive. I mean, the price to books, the price to earnings, and price to sales and all that are much more lower versus the S&P 500. And at the same time, the green bars show that they're low enough to be very statistically different than the benchmark. So it's worthwhile. So every time you have a green bar, it's interesting to have versus when you have a red bar, that means you're maybe giving something up. And actually, because of adding in small cap, the only portion you're really giving up a bit is the yield. But at the same time, you're giving up that yield to get the growth component. If you look at the strong growth component, you're getting some very interesting earning per share growth on a year basis, nearly 67 versus a 40 for the index. And at the same time, the quarterly sales growths are much higher than the ones you see on the S&P 500. So on the long run, this should help the portfolio to have a very good valuation or to see kind of an upkeep on the multiples on that part there. Plus, the consensus on that fund there is very interesting because versus the index, you see that the price changes are on the positive side. So everything something happens, it's positive for this fund here. Plus, the quarterly estimate revisions are more positive than the ones we see on the S&P 500. So you get roughly 5 versus 2.3. You need to see that the pickup that you're getting there is the revisions are very positive on the same side, and it's helping you to get your multiples much more in line. And the quality of the fund, if you look at the accounting and governance, it's pretty strong, 2.6 versus a 2.1. You're having a very good quality and a good governance fund at that level there. Could we switch over to slide 22 now, Matthew? Now, once we've got that in place, the question is, how can we integrate this asset class, a small part, into this fund, and at the same time, how we get the results? So can you jump to slide 23, please? Well, the first thing is we had to start off, we're going back in 2014, we're talking with the guys at SSQ, is to be sure that we're able to find the right allocation from adding in some small caps. So the usual manager on average adds in 5 to 10% as I showed you. The question is, could we push that boundary a bit more? Could we add a bit more small cap without, I would say, falling off the cliff. The question is to be sure we have the right blend, the right mix, to be sure that we're getting the right potential value add without taking unnecessary risk. So we see over time that since a period of time, we try to test both of our strategies for the period from 1997 to 2014. And we did those tests on multiple portfolios where we tested what we call the active management metrics. So are we able to add value? What is our batting average? Can we upside on the upside and downside markets? The return and risk metrics, are we creating more alpha without taking less, well, by adding in more risk or less risk? Is the risk versus the total tracking error, which we call the benchmark, is it better or worse? And are we being sure that technically it's well monitored? So for every dollar of unit risk we're taking, are we being compensated in the right way? And also, once you do that, it's always nice, but be sure that you don't do any kind of data mining or any kind of data selection that's really could be very pervert on a long time. We did some stress tests on certain periods of time to be sure that technically this portfolio was able to outperform, be robust enough to be able to outperform those kind of scenarios where it's really not going good, such as the 2007 financial crisis. These were very important for us. And once we did all those tests there and talking over with guys with SSQ, well, the blend was very simple. It was roughly 67% of the portfolio should be exposed to the U.S. cores, which means the U.S. large cap space, and 33% should be exposed to the U.S. small cap strategy. So we want to be sure that that was in place, and that was done in 2014. So the question is, have we maintained those things and how we did it? So if we could go to slide 24, please, Matthew. Before starting off, we have to be sure technically we have the right investment objectives. We're trying to shoot for the right things. And when we got sat down with the guys from SSQ, we gave ourselves what is the return target that we want to shoot over a long time. And we're talking a long time here is 5 to 7 years if possible. So we said 4 to 6% should be something an objective by adding small cap should be very interesting, and we should be able to hit that part there. Volatility, we have to have a volatility pretty well similar to the market. And we knew it would be a bit higher because by adding in some small cap, you should increase a bit that volatility. And so we had to give up that part there, but at the same time, we didn't want to give too much tracking error. We want to be sure that every unit of risk we took, we were able to compensate it with something very interesting on the return objective. So we say 68% should be the tracking error on average. We have about 2/3 of the time we should be in that space there, and that's how we think. Now, since the last crisis and all that, people have one very old thing, which is always interesting. The bull and bear capture. We want to be sure everybody's able to take risks when it's going up. When it's going down, people get more nervous and they do irrational factors on part there. So talking with the guys with SSQ, we say, well, maybe we should put a kind of a defensive thing to be sure that if something does happen, we do not tank as much as the benchmark. So for every dollar the benchmark will be down, we should be down only by 80 cents or 90 cents on average. And sometimes it's even better. We have some crises where the portfolio was able to protect, I would say, 25 to 30%. So when the market was down by 1%, we were only down by maybe 60 to maybe 70 basis points. So there is a good protection behind that by selecting the right names and putting in the portfolio in the right construction. If we go now to slide 25, please, Matthew. You could see now, since we changed the mandate, with this new mandate, the alpha that we were looking for is getting there. So roughly on a rolling, this is a rolling 250 days rolling period, we added roughly nearly, we're getting there, and the alpha is about a 3.4% at the end of this year. Now, if you go to slide 25 to 26, please, you see we haven't taken much more risk. Yes, it's a bit higher, but at the same time, the numbers are not so different. And at the same time, the benchmark, for some XY reasons, it's the classic risk on, risk off over, I would say, since, June 2016, risk was off. So a lot of the names were perceived non-risky, and lately we saw that the market came back, and since, I would say, roughly November, December 2017, the market is becoming more and more normal, and volatility has been picked up. So it's not us that has changed, it's more the market that has reacted in a very funny way. And it happens to the part of the market. If you go to slide 27, you see that the tracking error budget has not been overtaken. So it's still well considered control in that part there. So we're not taking much more risk, and we should be able to add the value in such a way that technically this risk has been compensated big time. Let's go to slide 28. Slide 28 shows you the beta. So we see the beta has creeped up while the period of risk on and risk off was not there. But lately, as I mentioned, risk is back. So our beta is much more normal, closer to the one that we're trying to shoot for. And if you look at slide 29, these are the results of this fund. And since inception in October, well, 1st of November 2015, we were able to add roughly 420 basis points. So we're getting pretty close to our investment objectives. The good news, both components of this strategy have generated what we were expecting for. So just to keep up with the large cap space, our fund is able to maintain that part there by 15.4 versus the 12.9 for the index. So you're getting a 250 basis points on 67% of the assets, which is the large cap space. And the risky part now, the 33% that you're taking, has generated roughly a 19.1% of return, which is very different to the benchmark, which is nearly 620 basis points. So the additional risk that we have added by just going into a small cap has paid off big time. And you need to see over time, it's not linear. Every period of time, you're getting some very interesting things. 2016 being small cap was very good. Year to date for 2018, small cap is the game. It was very pain. 2017, our friends on the large cap helped us out. So the good news by just having two engines for the price of one in this strategy, you're well diversified, you're able to add in some value add, and you're not taking much more risks than the real benchmark. So in a certain way, your potential on the long run is maintained, and it should be going good over time. Could we go to slide 30 now, please? Now, the question is, yeah, that's the past. What's for the future? So this is going to give you kind of a portfolio positioning, what we're seeing for the next 6 to 12 months, and a bit of the market outlook, things for you to think it over when you're talking with your clients or the prospects of your clients. If you could go to slide 31, please, Matthew. This slide, as I mentioned to you, shows that it's very attractive. The fund has very good quality, value, and growth momentum attributes. So by tapping into those markets there for the next 6 to 12 months, if the market maintains its level and what we see, we should be able to outperform and maintain things. The only wild card we have actually is, let's be very honest, is Mr. Donald Trump. You never know. But at the same time, that's the best part. We're well diversified. So one end, you got the large cap. It's going to hurt them. Then our small cap's going to be able to perform very well. And the other way around, if it's the small cap names that will be, I would say, the dogs for that period there, at least the large cap names will be able to add some value there. If you go to slide 32, please, Matthew. You see that we find actually on the total fund, we're finding names, very interesting names of overweight in the healthcare, information technology, and materials. These are the places where we will have our financials, where our money is going to be put to work the most. So these are where we find the best opportunity set, and we think that over the next 6 to 12 months, they will be the names that will be able to outperform the benchmark. And the reasons behind that are very simple. If you go to slide 33, please. Let's be honest, U.S. manufacturing is picking up. Even with what's happening down south with our friend Donald, it's still picking up. There's some good news there. So there is a little momentum there. So even versus Canada, it's picking up much more. And even versus the European or other countries, it's much more stronger. So the economy of that part there is helping. The manufacturing part is there. So it should spill down slowly but drip down into the companies we have invested in. Now, if we go to slide 34, we also have seen that the earnings revisions are positive. You see over time, things are picking up, and every different little factors, the estimates are in color. That's for each year. The trend is positive. It's always going upside. So that's very good for us. It's meaning that technically the market is doing good, their earnings are there, and as long as the companies are able to generate those earnings, we should have no, I would say, backlash on that part there. So the momentum is on the S&P 500 side also. Now, the question marks are what's coming. Slide 35, please. The tax reform. Good news, it favors much more smaller cap names than larger cap names. So on the domestic side, if things get very tight with Mr. Trump on his NAFTA trades and all the other factors and all that, well, there's a possibility that the smaller cap names, which are much more domestic, should be taken advantage. Plus, with those tax rates that are being lowered down for those guys there, the profitability of those companies should be higher. So the earnings should go up, and even if the multiples stay at the same level on both sides, the ones that will take the most advantage will be the smaller cap names. Could we go to slide 36 now, please, Matthew? Other question, yes, rates are going up. In all countries, rates are going up mostly. Even in the U.S. part, we see rates going up. The question is, will that have an impact on the U.S. economy? Well, or the companies. So if we look at slide 37, please, Matthew. We did some tests, and over time, we noticed that technically, when rates are picking up, it does advantage small cap. And it's normal too, because small cap are more growthy names, much more influential from inflation. And I would say the inflation parts come down much faster down in the earnings on smaller cap names than large cap names. So if the rates do go up, that means the economy is really picking up. That means everything is good. So on average, small cap should outpace the large cap names. And if we do have, I would say, rates higher than 50 hikes higher than 50 basis points, well, in that case, there on average, the smaller caps will outsmart or outbeat the larger cap names. So there is an advantage to have some small cap names in your portfolio if the concern is more on interest rates hikes. Slide 38, please. So, like I said, on 30 minutes, any questions now?
Okay, well, thank you, Johnny. So,
No
like
problem,
you said, we'll head into the Q&A part of the presentation. So, first question we have: why limit the weight of the U.S. small cap equity strategy to 33%?
Well, like I said, when we did our studies and all that, we could have pushed it up much more. Yes, the problem is there's a kind of an inflection point where you say when you're taking more risk, the classic financial things, more risk means more return. Well, sometimes there is kind of a 10 convection point where you hit a point, it breaks, and it doesn't hold up anymore. So for every unit of risk you were taking more above that 33%, you are not compensated on the long run. There were some periods, yeah, you did some very good money, but you gave it back all the way back in certain other periods. So if you want to survive over the long run, you better have something very robust. So that 33% was the normal part where the inflection point was at its most optimal view between return and risk on the absolute side and even on the relative side, which means the tracking error. So these were the best numbers to have.
Okay. And second question, do you think the market cycle for small cap stocks is over? Yeah.
Well, it is true. I mean, they had a good run. I mean, let's be honest, it was a good run. And if I was an asset manager on the macro side, I mean, my concern would say, yeah, it's maybe overrun. The problem is, it's like the classic. The easy money is gone. Now the question is, can we make more money with small caps? The answer is yes, because these companies have very interesting growth, much more breadth. So on an active side, no, the market's not, the cycle is not over. On a passive side, I'd say you're getting close to it. But on the active side, yes, there's some very better opportunities. And with what's happening down in the States, you're going to have some more some M&A activities. You're going to have some much more interesting movements because with the NAFTA trades and all those factors there that Mr. Trump is doing that, there will be some opportunity sets will be showing up. And at the same time, you have to take advantage of those. The question is, you cannot drown the whole thing with just the index. You have to look on the active side more and more. So for me and us, no, there's some very potential on the small cap space, Matthew.
Okay. And last question that we have so far, how can you keep track of so many small cap securities?
Well, like I mentioned to you guys at the starting off, Hillsdale is a fundamental quant. So all our thinking is done on a fundamental basis like all classic managers, just that we do our work on a more quantitative base. So we're able to manage much more data by doing that. We're focusing on the right things, and we're doing the computers do the hardest stuff, which is always trying to maintain the data in that part there. So yeah, to maintain roughly 40,000 stocks, it's if you were just a classic old manager and all that, you might go crazy. But being fundamental quant, the quant side helps you to manage those names much more efficiently. You're able to create much more data and a much more breadth. So if you look back in the appendix, we look at the breadth to give us the view and at the same time the historical data. So on a quant side, this is why we're able to maintain much more names in our portfolios and to maintain track of those names in a very efficient way, in a very easy way also. That's it, Matthew.
All right. Well, thank you. We have no more questions right now, so this will conclude the presentation. To all of you who listened to the webinar, thank you for your participation, and come back in September for the next webinar. So thank you, everybody. Have a good day. Thank you, Johnny.
Thanks, Matthew. Thanks, everybody.